Okay, so it looks like I have a client coming in for tax filing. Okay, and hello, my friend. My name is Andia, and I am going to be your accountant today. I understand that you are coming in to get your taxes filed, is that correct? Okay, and you are aware that taxes are due tomorrow, correct? Okay, as long as you're aware, let's go ahead and get started. So I'll just need to gather some basic information from you first. So let's go ahead and start with your name. What is your first and last name? Okay, and how do you spell that? Okay. All right. And your social security number, Okay. All right, and what filing status will you be using today? You're not familiar with the filing statuses? Okay, well, there are 5 filing statuses. There are 5 filing statuses, and that is single, married filing jointly, married filing separately, head of household, or qualifying widow or widower. So, which status do you think you will be utilizing today? You're still not sure? Okay, well, could you tell me a little bit more about your marital status and what's going on there that you wouldn't be sure? Okay, let me write this down. Okay, so you were recently married. Congratulations. And your spouse is a non-resident alien of the United States. Okay, yes, that does make things a little bit more complicated. Okay, so yes, I think we're going to go ahead and need to consult the tax code in order to see what the best filing status for you would be. So let's go ahead and do that now. All right. Okay, here it is. Non-resident alien spouse. If you are married at the end of the year and one of you is a U.S. citizen or resident alien and the other spouse is a non-resident alien, a joint return may be filed only if both of you make a special election to treat the non-resident alien spouse as a U.S. resident, which means you will both be taxed on your worldwide income. The same rule applies if one spouse is a dual status taxpayer for the year. Thus, if you are a U.S. citizen and your spouse is a non-resident alien at the beginning of the year who becomes a resident during the year, the special election must be made to file jointly. The election is made by attaching a signed statement to the joint return indicating your intent to be treated as a full-year U.S. resident. If you and your spouse make the election, you must keep books and records of your worldwide income and give the IRS access to such books and records. If the election is not made, you may be able to claim your non-resident alien spouse as an exemption on a return filed as married filing separately, but only if the spouse had no income or could not be claimed as a dependent by another taxpayer. Does that help clear things up for you? Okay. Let's go ahead and proceed then. So, I'm sorry, what was that? Yes, the filing status that you choose is going to affect your tax rate. How do tax rates work? I'm glad you asked. Okay, tax rate. Okay, here we go. What is your top tax bracket and effective tax rate? Depending on your taxable income, ordinary income such as salary, interest income, short-term capital gains, or retirement plan distributions such as IRA, 401k, etc., can be subject to one or more of the following tax rates: 10%, 12%, 22%, 24%, 32%, 35%, or 37%. Rates on qualified dividends and net capital gains can be either 0%, 15%, 20%, 25%, or 28%, depending on the amount of your other income and type of asset sold. The 2023 rate brackets that apply to income other than net capital gain or qualified dividends are shown below in Table 1-1. If your top bracket is 22%, for example, this means that each additional dollar of ordinary income will be taxed at 22% for regular income tax purposes. 22% is your marginal tax rate. However, because the rate brackets are graduated, your effective tax rate may be significantly lower than your top or marginal rate. For example, if in 2023 you are single with taxable income of $45,205, all of which is ordinary income, your marginal rate is 22%. But the first $10,275 is taxed at 10% for a tax of $1,027.50. The next $31,500 is taxed at 12% for a tax of $3,780, and only the last $3,430 is taxed at 22% for a tax of $754.60. The total tax on the taxable income of $45,205 is $5,562, which represents an effective rate of 12.30%. Reflecting the fact that most of your taxable income is taxed at the 10% and the 12% brackets, and only a small amount at your top marginal rate of 22%. If you have substantial employee compensation and/or self-employment net earnings in excess of the applicable threshold for your filing status, you are subject to an additional 0.9% Medicare tax on the excess earnings. I trust that you fully understand your tax bracket now. Okay, wonderful. Let's continue on then, shall we? Will you be filing for anyone else today or just yourself? Okay, so for example, if you had a child who is working a part-time job and making taxable income, or filing for a recently deceased family member. You didn't know that you had to file for a deceased family member? Oh yes, you very much do. You very much do. Okay, so you did recently have someone pass away that you may need to file a return for? Okay. Okay. Tell me a little bit more about that. Okay. Yeah, so again, that's another unique situation. Let's go ahead and consult the book to see if you may need to file that additional return. Okay. Okay, deceased family member, deceased. Okay. Return for deceased. When a person dies, another tax-paying entity is created, the descendant's estate. Until the estate is fully distributed, it will generally earn income for which a return must be filed. For example, Carlos Perez's only income is salary and bank interest. He dies on June 30th, 2023. The wages and bank interest he earned through June 30th are reported on his final income tax return, which is due by April 18th, 2024. Interest earned on his bank account after June 30th is attributed to the estate or to the account beneficiary if the right to the account passes by law directly to account beneficiary. Income received by the estate is reported on Form 1041. The income tax return for the estate if the estate has gross income of $600 or more. If Carlos was married, his surviving spouse could file a joint return for 2023 and include all of Carlos's earnings through June 30th. If she jointly owned the bank account with Carlos, the interest after as well as before June 30th could be reported on their joint return. What income tax returns must be filed on behalf of the deceased? If the individual died after the close of the taxable year, but before the income tax return was filed, the following must be filed. 1. Income tax return for the prior year. 2. Final income tax return covering earnings in the period from the beginning of the taxable year to the date of death. And 3. Estate income tax return covering earnings in the period after the descendant's death. If the individual died after filing a return for the prior tax year, then only 2 and 3 need to be filed. Does that clarify for you whether or not you would need to file for a recently deceased family member? Okay. Let's go ahead and move on then, shall we? Let's talk about your income, one of the most important parts of filing taxes. Did you bring your W-2 today? You did. Okay, wonderful. Go ahead and hang on for that for right now, because we need to go over what a W-2 actually is before we can look at your specific W-2. W-2. All right, here we go. The key to reporting your pay in Form W-2 sent to you by your employer. It lists your taxable wages, which may include not only your regular pay, but also other taxable items, such as taxable fringe benefits. Your employer reports your taxable pay under a simple rule. Unless the item is specifically exempt from tax, you are taxed on practically everything you receive from your work, whether paid in cash, property, or services. Benefits that the law specifically excludes from tax are discussed in Chapter 3. The most common tax-free benefits are employer-paid premiums for health and accident plans, medical expense reimbursements, and group term life insurance coverage up to $50,000. your employer will include in Box 1 of your Form W-2 the total wages, tips, commissions, and other compensation before payroll deductions that were paid to you during the year. Box 1 may include, in addition to regular wages and tips, the following types of taxable compensation: bonuses, including signing bonuses; taxable fringe benefits; per diem or mileage allowances exceeding the IRS rate; expense allowances or business expense reimbursements under a non-accountable plan; moving expense reimbursements unless you are a qualifying member of the U.S. Armed Forces; awards or prizes not exempt under Statute 3.11; cost of group term life insurance over $50,000; cost of accident and health insurance premium paid by an S corporation for 2% or more shareholder employees; deferred income that is currently taxable under Section 409A, Non-Qualified Deferred Compensation Plan; and finally, severance pay. Compensation reported in Box 1 of Form W-2 must be reported as wages on Line 1 of Form 1040 or 1040-SR. Other types of income must be reported as wages on your return, although they are not included in Box 1 of Form W-2, such as non-excludable dependent care, adoption benefits, tips not reported to your employer or allocated tips, disability pensions shown on Form 1099-R, if you are under your employer's minimum retirement age, or excess salary deferrals to an employer retirement plan. Does that help you understand a little bit more about what your W-2 is for? Excellent. So with that being said, let's go over your W-2, shall we? I will go ahead and take that from you. Thank you very much. Okay, so we have your W-2 here, and as we can see, Box 1, as we discussed, is for your wages, tips, and other compensation, and it looks like in the year 2023, you earned $98,500. You did very well for yourself. Congratulations. So moving on to Box 2, which is federal income tax withheld. That is a total of $15,000. Box number 3 is Social Security wages, which for you was a total of $100,000. Box number 4 is for Social Security tax withheld, which for you was $5,000. Box number 5 is for Medicare wages and tips, which again was $100,000. Box number 6 is for Medicare tax withheld, which for you was $1,100. As you can see, boxes 7 through 11 are empty, so we will not be needing to consider those for filing this tax return. Moving on to box number 12A, that contains an amount of $1,500. And box 12B has an amount of $1,000. Moving all the way down to box number 16. This is your state wages, tips, etc., which for you was $100,000. And box number 17 is for your state income tax, which for you looks like $3,000. Box number 18 is your local wages, tips, etc., and that was $100,000. Box number 19 is your local income tax, and that is an amount of $4,000. Does everything on your W-2 look to be correct to the best of your knowledge? Okay. So, I am going to go ahead and enter the information from your W-2 into our computerized system so that we can better file your taxes. Is that all right with you? Excellent. All right, so box number 1 is an amount of $98,500. Box 2 is $15,000. Box 3, $100,000. Box 4, $5,000. Box 5, $100,000. Box 6, $1,100. Skipping all the way down to box 12A. Box 12A, that is $1,500. Box 12B is $1,000. And coming all the way down to box 16 is $100,000. Box 17 is $3,000. Box 18, $100,000. And box 19 is $4,000. Okay. Everything seems to be entered correctly into our system, and it looks like the IRS is agreeing with those calculations. So everything on your W-2 looks to be correct as far as we can tell. Do you have any questions for me about what is or is not included on your W-2? Workers' comp? Okay, you had a workers' comp case last year? Okay, well, workers' comp does complicate things a little bit, so I feel we should probably consult the book on that as well. Alright, workers' comp. If I was workers' comp in this book, where would I be? Workers' comp. Alright, here we go. Oh, lucky you. Workers' compensation is tax-free. You do not pay tax on workers' compensation payments for job-related injuries or illness. However, your employer might continue paying your regular salary, but require you to turn over your workers' compensation payments. Then you are taxed on the difference between what was paid to you and what you returned. For example, John Wright was injured while at work and was out of work for 2 months. His company continues to pay his weekly salary of $775. He also receives workers' compensation of $200 a week from the state, which is tax-free. He gives the $200 weekly payments to his employer. The balance of $575 a week is considered taxable wages. To qualify as tax-free workers' compensation, the payments must be made under the authority of a law or regulation having the force of a law that provides compensation for on-the-job injury or illness. Payments made under a labor agreement do not qualify as tax-free workers' compensation. Okay. I'm glad we were able to clear that up for you. We are almost done discussing your income, and then we can move on to discussing your deductions. Before we conclude talking about your income, do you have any fringe benefits? For example, an HSA or an education assistance plan? You're not sure? Okay. Can you tell me a little bit more about that? Okay. So you do have some kind of health savings plan, but you're not sure if it's an HSA or an MSA? All right. Let's go ahead and consult the book then, shall we? HSA. HSA. All right, here we go. Health saving accounts, or HSAs, and Archer MSAs. If you are covered by a qualifying high-deductible health plan, your employer may make tax-free contributions to a health savings account, or HSA, on your behalf. Earnings accumulate tax-free within an HSA, and distributions are tax-free if used to pay your qualified medical expenses, or those of your spouse or dependents. If your employer does not make a maximum tax-free contribution to your HSA, you can make a deductible contribution as long as the total does not exceed the annual contribution limit. Archer MSAs are an older type of medical saving plan that HSAs are intended to replace. If your employer set up an Archer MSA on your behalf before 2008, or you became eligible to participate after 2007 in a pre-2008 plan, your employer may continue to contribute to the account. If you work for an eligible small employer with a high deductible plan, your employer may make tax-free contributions to an Archer MSA on your behalf. A rollover can be made from an Archer MSA to a new health savings account that accepts rollovers. If the Archer MSA is retained, withdrawals will be tax-free if used to pay for qualified medical expenses for you, your spouse, or your dependents. Does that clarify for you whether you have an HSA or an MSA, an HSA or an MSA? Okay, wonderful. I'm glad we could clear that up. Do you have any dividends or interest income to report? Okay. Okay, so you have both. All right, well, let's go ahead and see what that entails, shall we? Dividends, reporting dividends. Here we go. Dividends paid to you out of a corporation's earning and profits are taxable as ordinary income. The corporation will report dividends on Form 1099-DIV or equivalent statement. Mutual fund dividends and distributions are also reported on Form 1099-DIV or similar form. Mutual fund dividends and distributions are also reported on Form 1099-DIV or similar form. Corporate dividends and mutual fund distributions of $10 or more are reported on Form 1099-DIV or equivalent, whether you receive them in cash or they have been reinvested at your request. Form 1099-DIV. Form 1099-DIV gives you a breakdown of the dividends and distributions paid to you during the year. If you were a shareholder of record in mutual fund or real estate investment trust during October, November, or December of 2023 and entitled to a dividend declared in one of those months, but the dividend was not paid to you until January 2024, it will be reported to you on your 2023 Form 1099-DIV as if it had been paid before the end of the year. The company or fund may send a statement that is similar to Form 1099-DIV. You do not have to attach Form 1099-DIV to your tax return. Box number 1A. Ordinary dividends taxed to you as shown in Box 1A. These are the most common type of distribution, payable out of a corporation's earnings and profits. Your share of a mutual fund's ordinary dividends is also shown in Form 1099-DIV. Short-term capital gain contributions are included in Box 1A total. Box 1B. Part of the Box 1A amount may be qualified dividends. Qualified dividends reported in Box 1B are generally taxed at the same favorable rates, 0, 15, or 20, as net capital gains. Any net capital losses, however, do not directly offset qualified dividends, despite their sharing the same rate structure. Boxes 2A through 2D. Capital gain distributions, long-term, from a mutual fund or real estate investment trust, are shown in Box 2A. Box 2B shows the portion of the Box 2A amount, if any, that is re-encaptured Section 1250, gain from the sale of depreciable real estate. Box 2C shows the part of Box 2A that is Section 1202, gain from small business stock eligible for an exclusion. Box 2D shows the amount from Box 2A that is 28% rate gain from the sale of collectibles. If any amount is reported in Box 2B, 2C, or 2D, you must file Schedule D with Form 1040 or 1040-SR. Box 3. Non-dividend distributions that are a non-taxable return of your investment are shown in Box 3. Box 4. If you do not give your taxpayer identification number to the payer, backup withholding at a 24% rate is shown in Box 4. Box 5. The portion of ordinary dividends that is eligible for the QBI, or qualified business income, deduction is shown in Box 5. Box 6. Your share of expenses from a non-publicly offered mutual fund is shown in Box 6, which is included in Box 1A. Due to the suspension of miscellaneous itemized deductions subject to the 2% of adjusted gross income floor, they are not deductible. Boxes 7 and 8. The foreign tax box shown in Box 7, imposed by the country shown in Box 8, may be claimed as a tax credit on Form 1116 or as an itemized deduction on Schedule A, Form 1040 or 1040-SR. Boxes 9 and 10. Cash and non-cash liquidation distributions are shown in these boxes. I trust that answers all of your questions regarding dividends. Okay, wonderful. We are almost done talking about your income. One last question. Have you sold any property in the past year? Okay. And what were your net profits off that sale? Okay. All right. So finally, we need to figure out your adjusted gross income. I take it you already know your AGI, or adjusted gross income, down to the exact cent? You don't? Okay. Well, then we will need to calculate your AGI. Back to the book. All right, adjusted gross income, adjusted gross income, adjusted gross income. All right, here we go. Figuring adjusted gross income. Adjusted gross income is the difference between gross income in Step 1 and the deductions listed in Step 2. Step 1. Figure gross income. This is all income received by you from any source, such as wages, salary, tips, gross business income, income from sales and exchanges of property, interest and dividends, rents, royalties, annuities, pensions, etc. But because of exclusions allowed by the tax law, gross income does not include such items as tax-free interest from state or local bonds, tax-free parsonage allowance, tax-free insurance proceeds, gifts and inheritances, certain home sale gains, Social Security benefits that are below the threshold for being taxed, Supplemental Security Income or SSI, tax-free scholarship grants, tax-free meals and lodging, and other tax-free fringe benefits. Step 2. Deduct from your 2023 gross income only the following items. Repayment of supplemental unemployment benefits required because of receipt of trade readjustment allowances. Forfeiture of interest penalties because of premature withdrawals. Capital loss deduction up to $3,000. Traditional IRA contributions. Rent and royalty expenses. Educator expenses. 50% of self-employment tax liability, health savings account or HSA contributions, health insurance premiums if self-employed or treated as such, jury duty pay turned over to your employer, performing artists qualifying expenses, reforestation expenses, reservists travel costs, state and local official expenses, moving expenses for certain military personnel, student loan interest, alimony payments under a decree or agreement entered into before 2019, business expenses, net operating losses, self-employment retirement plan contributions for yourself, and Archer MSA contributions. Step 3. The difference between steps 1 and 2 is adjusted gross income. I take it you now know what your adjusted gross income is? And that is an exact number down to the exact cent. Okay, perfect. Now that we have your adjusted gross income, let's talk about your deductions. Will you be claiming the standard deduction or itemizing your deductions? Okay. Have you made any charitable contributions in the past year? Okay, and what organizations were those to? Okay. And for what amount? Okay, and will you be claiming any medical or dental expense deductions? Okay. All right, and we are almost done. Final question, do you have any dependents that you will be claiming? Okay, you're not sure who qualifies as a dependent? Okay, well, let's go ahead and go over that then, shall we? Alright, dependents. Alright, here we go. You claim someone as your dependent by naming that person and providing his or her social security number in the dependents section on Form 1040 or 1040 SR. To claim someone as dependent, he or she must be either your qualifying child or your qualifying relative. You must have a qualifying child under age 17 to claim the child tax credit or the additional child tax credit on your 2023 return. You must have a qualifying child over the age of 16 or a qualifying relative to claim the credit for other dependents on your 2023 return. To file as a head of household, you must maintain a home for a dependent, a qualifying child, or qualifying relative. Similarly, for qualifying widow/widower status, you must maintain a home for a dependent child who lives with you. In addition to meeting the tests for a qualifying child or qualifying relative, a child/relative can be your dependent only if he or she meets a citizen or resident test, and if married, he or she generally must file separately. Finally, a dependent cannot claim someone else as a dependent. This means that even if a person meets the tests for being your dependent, you cannot claim that person as your dependent if you, or your spouse if filing jointly, can be claimed as a dependent by another taxpayer. Do you have a qualifying child for 2023? In addition to a biological child, a qualifying child can include your stepchild, adopted child, foster child, sibling, half-sibling, or step-sibling, and the descendants of any of these, such as grandchild, niece, nephew, and provided all of the following tests are met. 1. The child had the same principal place of abode or residence as you did for more than half of 2023. Temporary absences are disregarded. 2. The child is under age 19 at the end of 2023, or under the age of 24 at the end of 2023 if a full-time student during any part of at least 5 months during the year. In addition, the child must be younger than you are, or younger than your spouse if you file jointly. However, there is no age limit if the child is permanently and totally disabled at any time during the year. Keep in mind that a lower age limit applies for purposes of the child tax credit and the additional child tax credit. For 2023, your child is a qualifying child for purposes of these credits only if he or she is under the age of 17, although for other dependent rules, the under age 19 or under age 24 test in the previous paragraph applies. 3. The child did not provide more than half of his or her own support for 2023. 4. If married, the child does not file a joint return for 2023 unless the joint return is filed only to claim a refund of income tax withholding or of estimated tax payments. For further details on the clarifying child rules, indicating the tiebreaker rules that determine whether you can claim a child as dependent when the child is a qualifying child of more than one person, please see Table 21.3. And finally, do you have a qualifying relative for 2023? An individual is your qualified relative for 2023 if the following 3 tests are met. 1. The individual is your relative or member of your household, but that person must not be your qualifying child or the qualifying child of any other taxpayer. That person also cannot be your spouse, as a spouse cannot be your dependent for tax purposes. 2. The individual's gross income for 2023 is less than $4,400. And 3. You contributed over half of the individual's support for 2023, or you contributed more than 10% of his or her support, and the other contributors of more than 10% agree to let you claim the individual as your dependent under the multiple support agreement rules. Does that help you clarify whether or not you will be claiming a dependent? Okay, perfect. So that was really the last piece of the puzzle. And I believe it looks like we have all the information we need to be able to file your tax return. Do you have any questions for me? Okay, well, I'm going to go ahead and get to work on this right now. And good night, my friend.